Hello traders, Gary Wagner here, just about 10:30 in Honolulu, 3:30 in New York. It is Wednesday, December the 30th, 2015, and this is the Daily Report for Gold and Silver. With approximately 2 days left in trading, we do have the precious metals complex under pressure, and it's pretty strong pressure today. You've got gold trading off about $8 on the day at $10.5980. It is traded to a low of 58.50, so we are just off of the lows, and the high 1071.50. Gold is trading off about 0.75%, and that's that $8 drawdown. When we look at silver on the day, although it's down less in terms of percentage, down about 0.6%, it is off 80 cents, well below $14 again at $13.85 on the day. The low 79 and the high is 99. Traders, as we come to the end of the year, I thought we would take a long-term look at the year that was. If we take a look at our first marker, this of course, it's a monthly chart, not used for trading, but really it's going to give us some key elements in the market. But the highest point that this market traded to was really in January of this year, January of 2015, and we actually saw it trade above 1300 at around 1310. Now, if we look at just the slope or tact of the market, obviously down when we consider that the high is above 1300 and the low is closer to 1050, you can see the kind of move that we've seen throughout the year. It's been a difficult year at best. And another couple of things that are pretty apparent, you have a high, you have a lower high, you have a lower high. Now then these two highs come in slightly higher. So really these are the only two highs from the beginning of the year that actually exceed the previous month. And then following that, we go back into the pattern in which we have a series of lower highs. And that's up until October. October is the one little blip month that we do see it go up. But obviously November and December are all coming in with lower highs. So out of 12 months, only 3 of them have had a high that was not lower than the previous month. Now, lower lows. We're getting lower lows consistently throughout the year, and the only time we actually get any kind of support, it's almost like a flat bottom. In other words, you're not getting support and then seeing the market move back up. So all in all, we can absolutely say that 2015, in terms of gold prices, was the year of the bear. Now, another thing that we want to look at when we look at these long-term studies is the fact that we have to, at some point, look for potential support in the market. We've been in a dramatic decline really since 2013. That's when we hit these tops at around 1800, and it was also the last time that we saw gold trade to 1800. Happened in towards the end of 2012. From there, we have seen a steady decline. You can see the slope or the tact of this market move down. And so the question now is, where will it potentially find support? Now, we talked about different levels and they were all fib based, but the one real area that we've talked about on a number of occasions has been based upon this particular bottom here, and that comes in roughly at 1036. And then the big number that I've talked about, which has been $1,000. You can really see these series of tops here. And of course, as the market came up, here it's resistance, it comes back down, trades to about 700, that becomes support. And it, for a number of months, it tried to break that $1,000 ceiling and could not. Now, when you take that into consideration, along with the fact that quantitative easing has in fact been the impetus to see the market move up, and the fact that that has ended has been the real impetus to see the market move down, we want to really take a look at where the market was trading at during the times of quantitative easing. So traders, I've done just that and gone ahead and pulled up a chart that has the U.S. equities represented by the Standard & Poor's 500 on the bottom and the gold market on the top. It's basically broken down as a weekly chart. I've also put little X's or little boxes here so you can kind of see the area. So we've got quantitative easing 1, quantitative easing 2, QE2, and QE3. And obviously what we see, this of course is going back 2008, 2009. We have a tremendous housing or banking bubble, I should say, really due to some very, very loose mortgages that were being put onto the market. Utter collapse in the financial market takes the equities markets down to a tremendous low at around 700 after being as high as 1600 on the Standard & Poor's. And you can see as the quantitative easing kicks in, it really starts to pump this market up. And then it ends, you've got huge amounts of money in the system, and it really ramps up the equities markets. Now, when we look at gold, it becomes a little bit different, because with gold, what we see is as follows. As we look at this market throughout history and see as these quantitative easing periods came in, QE1 market is trading roughly at 700, and that's after testing $1,000 for the first time back in 2008. Ramps the market up, no doubt, because by the time QE2 starts, the market has moved from 700 to 1200. And that's another major level in the market. And then, of course, QE3, which was really a twist, and it was a very, very meek or meager effort at quantitative easing. But at that point, the economy had been ramped up, and that's when we got into the cycle of trading between 1800 on the upside and 1534 on the downside. Once you got this break, and we talked about this too, we went through a series of stair steps moving down throughout the market. So step one, we had step two, and we're now in step three. So in determining where step three is going to actualize, and that's why I said I really believe that 1,000 is quite feasible, because 1,000 still puts us about mid-range between where the market moved for QE1 and QE2. To me, it is a very logical point to go to. I don't think we're going to go back to 700 the way the markets were prior to QE2, but we have this $1,000 mark, and I really think that that is what we can see as an achievable area. We're certainly probably going to see it go to 1038 before we're done. But as I said, that's a rough view of what I'm looking at next year and where I think the markets could potentially end. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow for the last report of the year. Bye-bye.